It has begun. The signals are now too loud to ignore, and the financial system is flashing warnings that only show up before major market resets. Housing has cracked. Credit markets have cracked. Free cash flow across major sectors has cracked. And if history repeats even slightly, stocks are next. Welcome back to Stock Predictor, where we break down the trends others hesitate to talk about. Today's video is one of the most important updates I've ever shared, because what's happening right now will shape the next 12 to 18 months of the financial markets in a massive way. So sit tight, stay focused, and let's dive into what's really happening behind the scenes. For the last 2 years, analysts, economists, and even big institutions have promised a soft landing. They said inflation would cool without hurting growth, rates would fall gently, consumers would stay strong, and corporate earnings would magically hold up. But the truth is finally cracking through the narrative. The first major break happened in the housing market, and this time, unlike 2008, the crisis isn't coming from reckless lending, it's coming from affordability collapsing. Mortgage rates hitting multi-decade highs have pushed millions of buyers out of the market. Sellers are stuck, buyers are frozen, and transaction volume has fallen to levels not seen in more than a decade. Builders are offering massive incentives just to move inventory, and even then, demand is weak. When affordability breaks to this extent, the correction is unavoidable. You cannot have homes priced at record highs while mortgage rates stay elevated. Something has to give, and we're finally seeing it give. Price cuts are accelerating across major U.S. metros. In some regions, new listings are sitting on the market twice as long as last year. Rental markets are softening, vacancy rates are rising, and landlords are now forced to cut rents to keep units filled. These aren't small adjustments. These are the first indicators of a structural shift. The housing market has cracked, and that alone is a major red flag for what comes next. But housing is only the beginning. The second major break is happening in the credit markets, and this one is even more dangerous. Consumers are now holding more credit card debt than any point in U.S. history, and they're holding it at the highest interest rates ever recorded. Delinquencies are rising across all age groups. Buy now, pay later apps are becoming the new subprime loans, and we're seeing a disturbing trend: people using one credit product to pay off another. That is the definition of a system under stress. Auto loan defaults are climbing. Subprime borrowers are experiencing the fastest increase in missed payments since the Great Recession. Banks are tightening credit standards at a rate that only happens before major recessions. When credit tightens and consumer debt is already maxed out, spending slows. When spending slows, earnings slow. When earnings slow, stocks correct. Now let's talk about the third crack, something Wall Street analysts almost never talk about publicly: free cash flow. Free cash flow is the strongest real-world indicator of corporate health, because it shows what money is actually left after expenses, debt payments, and operational needs. And guess what? Free cash flow across key sectors has fallen sharply. Tech companies, retail giants, transportation firms, and even industrial players are experiencing declining free cash flow, and some are outright negative. Yet somehow, stocks in these sectors are still trading near all-time highs. This disconnect is the most dangerous part of the current market. We have inflated valuations sitting on weakening foundations, and that combination has never ended peacefully. Here's the truth: big institutions will never say out loud. The reason free cash flow is collapsing is because the cost of capital has exploded. When rates rise, debt becomes more expensive, refinancing becomes harder, and companies that were barely profitable suddenly start bleeding. Many corporations grew during the low-rate era, borrowing cheaply, expanding aggressively, and relying on cheap money to fuel growth. But now, that era is over. The easy money model has collapsed. That is why stock buybacks have slowed. That is why guidance is being lowered quietly. That is why layoffs are increasing even in sectors that claimed they were recession-proof. These cracks are now too large to hide. And if housing has cracked, credit markets have cracked, and free cash flow has cracked, then stocks, historically, are next. Markets don't crash out of nowhere. They weaken structurally long before the drop happens. And right now, those structural weaknesses are screaming. So many investors are still distracted by short-term rallies, ignoring the deeper problems forming beneath the surface. But smart investors, those who understand cycles, are already positioning themselves. So what exactly is happening behind the scenes? Let's break down the chain reaction. When housing weakens, homeowners feel less wealthy. When people feel less wealthy, they spend less. When spending slows, corporate revenues fall. When revenues fall, companies cut costs. When companies cut costs, layoffs follow. When layoffs increase, consumer confidence drops. When confidence drops, spending slows even more. This is the feedback loop that creates recessions. And now, add tightening credit on top of that. When people can't access cheap credit, they stop spending on big purchases like cars, appliances, and home upgrades. Businesses stop investing in expansion because loans are too expensive. This freezes growth. Then combine that with falling free cash flow, and you get companies that are weakened financially just as the economy slows. When you mix all three cracks at the same time, housing cracking, credit cracking, and free cash flow cracking, the probability of a major stock market correction skyrockets. Let's talk about the stock market specifically. Right now, valuations in many sectors are pricing in perfection. They are assuming growth continues, earnings stabilize, and the consumer remains strong. But this assumption has no basis in current economic reality. The consumer is weakening. Credit is tightening. Housing is slowing. Corporate profits are under pressure. Yet stock prices are behaving as if none of these risks exist. This mismatch between fundamentals and price is one of the clearest warning signs that trouble is ahead. And here's the thing. Markets don't drop when everyone is scared. Markets drop when everyone is comfortable. When no one sees the risk. When the narrative is still optimistic. And that's exactly where we are right now. Everyone believes the soft landing story. Everyone believes the worst is over. Everyone believes the Fed will cut rates and magically solve everything. But the cracks are telling a very different story. Let's dig deeper into corporate behavior, because this is where the truth becomes impossible to ignore. A growing number of publicly traded companies are using creative accounting to hide rising costs and shrinking margins. Some are increasing debt without announcing it loudly. Others are reducing capital expenditures to keep earnings looking stable. Still others are laying off employees quietly without making major announcements. These strategies work in the short term. But they fail in the long term. You cannot hide declining free cash flow forever. Eventually, the numbers catch up. And when they do, stocks correct. Now let's discuss investor
psychology, because the emotional side of the market is just as important as the financial side. For the last decade, investors have been conditioned to believe that every dip is a buying opportunity. And for most of that decade, it was. But that mindset only works when conditions are improving, liquidity is abundant, and rates are low. Today, none of that is true. The environment has changed completely, but investor psychology has not. And this disconnect will cause a lot of people to get hurt when stocks finally reflect the real economic picture. Another major factor: liquidity is draining. The stimulus era is over. The government is not injecting free money. The Fed is not pumping liquidity into markets. Instead, liquidity is being pulled out, and markets thrive on liquidity. When liquidity dries up, volatility rises, corrections become sharper, and price swings become more violent. That's exactly the environment forming right now. If we study previous cycles, 2000, 2008, 2020, every major correction followed the same pattern. Cracks formed quietly first. Most people ignored them. Analysts downplayed them. Institutions reassured the public. Then suddenly, the market reacted. And once the reaction starts, it moves faster than anyone expects. This is why understanding the cracks now is so important. It allows you to position yourself before the crowd panics. So what should investors do right now? First, reduce exposure to highly leveraged companies. Firms with massive debt loads are the most vulnerable as borrowing costs remain high. Second, stay cautious with sectors tied directly to consumer spending. As credit tightens and delinquencies rise, these sectors face major risk. Third, build cash reserves. Cash is not just safety, it's opportunity. When markets correct, cash lets you buy great assets at great discounts. Fourth, focus on quality. Strong balance sheets, consistent cash flow, low debt, and real profitability matter more than ever in a high-rate environment. Investors who position early are the ones who win. Those who wait for the headlines always react too late. Remember, the cracks always show up before the crash. And right now, the cracks are here. Let's talk about what may happen next. If housing continues weakening, expect residential construction stocks to pull back first. If credit delinquencies continue rising, expect banking stocks, fintech stocks, and consumer discretionary stocks to feel pressure. If free cash flow continues declining, expect overvalued sectors with high price-to-earnings ratios to correct sharply. And if all three cracks worsen at the same time, which is now extremely likely, the overall market could enter a major correction phase in the next few quarters. This isn't fear-mongering, it's cycle awareness. Markets move in cycles. Economies move in cycles. Nothing grows in a straight line forever. And what we're seeing now is the natural unwinding of years of cheap money, overstimulation, and inflated valuations. The correction is not a matter of if, it's a matter of when. Now let me be clear. Long-term opportunity is coming. Some of the best investments of the next decade will come from the correction that's forming right now. Crashes create generational buying opportunities. But only for those who protect themselves before the crash happens. That's why videos like this matter. Not to spread panic, but to prepare you, to help you think ahead, to help you avoid the mistakes that wipe out portfolios. The best investors aren't the ones who predict the exact moment of the crash. They're the ones who recognize the environment early and position intelligently. And that's what I want for you. So if you're watching this right now, take a moment to step back from the daily noise, zoom out, and look at the bigger picture. It has begun. The cracks are forming. The signals are flashing. And the market is quietly shifting beneath the surface. Before I wrap up, let me summarize in the simplest way possible. Housing affordability has collapsed. Credit markets are tightening and showing stress. Corporate free cash flow is weakening across major sectors. Valuations remain inflated. Liquidity is draining. And investor psychology is overly optimistic. This combination has never ended with a soft landing in any major cycle. Something bigger is coming. Prepare yourself, stay aware, stay smart, and be ready for what's next. And if you found this breakdown valuable, make sure you subscribe to Stock Predictor for more deep dive financial insights. The next few months will be critical, and I'll be here to guide you every step of the way. Stay sharp, stay informed, and I'll see you in the next video.